Hello and welcome to another edition of BCR Webcasting. Today we're talking about opportunities and challenges for trade receivables securitization. And we're doing this in the run-up to our Alternative and Receivables Finance Conference, which will be taking place in London on the 27th and 28th of November. And I'd very much like to welcome Martynas Juskelis, who is Vice President of Structured Working Capital at JP Morgan, who will be speaking on this topic at the conference next month. Martynas, welcome.
Thank you so much.
Martynas, I'm interested to get your thoughts on how the market for trade receivables securitization is developing and how it's performing. Just give me your general views on that, and in particular the size of deals, which my understanding has come down in recent years. Well, let me clarify that. Let's say that we're seeing smaller deal sizes. The larger deals are still there, but deal sizes have also reduced in size over the years. Is that the case?
Absolutely, I would say so. In terms of, let's say, the deal sizes and the developments that we see in the market, especially in the EMEA, I would say in particular that large opportunities remain there. However, I would say the general trend is that on average, let's say the average ticket is definitely reducing in size. I would say that this is partly driven by the fact that the securitization industry, or the receivables financing and securitization in Europe in particular, is probably a bit more on the maturing side. That's where you see a lot of large corporates in particular and large players in the receivables financing market already having established, let's say, large transactions that they have been running for multiple years on the basis that, let's say, these are running well, they have been expanding. So let's say those large opportunities are naturally reduced. What we do see a lot as in terms of opportunities as well in our space is corporates who, for example, have already established large multi-year running securitization transactions that are very large in size. However, they are unable to, for example, include certain jurisdictions or certain obligors into those programs. That's where they look to arrange alternative financing programs just for those residual portfolios. So that's where that type of optimization in terms of working capital financing comes into play from our perspective as well, that we see a lot of demand on those sides as well.
And are you also seeing trade receivables securitization growing in comparison to the overall securitization market, including mortgages and because it always used to be quite a small percentage of that overall market. Is the market share for trade receivables securitization growing? Do you know?
I would say generally, well, we all know that the trade finance gap has been quite significant, and it has been growing over the years. It currently stands at multiple trillions of dollars globally. So the demand for working capital financing globally and the need for these structures remains active, and there's definitely a significant need by the corporates and by the alternative financing providers in the market. So I would say that the general trend is that this market is becoming a lot more accessible to a lot more corporates who are thinking about not just establishing traditional credit lines, but also looking to finance their working capital, not just in a simple or, let's say, opportunistic way, but also they're looking and actively thinking about establishing a permanent source of working capital financing facility that they can rely on for their liquidity purposes as well. So that's definitely a theme that we see in the market for sure.
And can you tell me anything about the sort of major deals that you've seen recently? And are these deals changing in their structure in any way over time? What's the sort of evolution dynamics of deals in recent times?
I would say that there is a sector activity interest that we see at the moment. So, for example, the likes of, let's say, industries that remain very active at the moment would be, let's say, the technology sectors, the energy sectors, well, energy and metals in particular. We also see a lot of activity with alternative funds or alternative financier providers, alternative financing providers. We're also looking to partner up with banks to achieve, let's say, working capital financing fund facilities to support their activities in the broader market. Overall, I would say the general theme is that these transactions that we normally see probably fall into two categories. The first one being, let's say, what I mentioned at the beginning. So let's say those, let's say, more bespoke transactions that come into play where there are, let's say, less liquid portfolios that cannot be, let's say, readily financed within existing working capital financing arrangements. So those are the deals that require a lot more thought, diligence. They might be in more complex jurisdictions. They could be less straightforward assets that require financing. They might not be just straightforward trade receivables that are self-liquidating, for example. So those, let's say, more complex assets in terms of structures, jurisdictions, or their, let's say, self-liquidating properties. That's where we see a lot of, let's say, activity, let's say, in group number one. Group number two would still remain, let's say, an active market. For us, it's where we see still, let's say, corporates who have probably the best way of saying it is that these corporates have fragmented receivables financing programs that they only run locally. For example, where they have chosen in the past to do a plug and play model, let's say for certain jurisdictions only, which has resulted in them over the years being in a position where they are currently running, let's say, tens of isolated receivables financing programs. And they are now looking to either simplify their operations so that they can have, let's say, a single multi-jurisdictional, multi-currency transaction, or let's say new corporates who are coming into the market who, for example, have not done this on a more global scale before, who are very much thinking about how to finance their working capital in the most efficient way, how to optimize their structures so that they can meet their needs, not just locally for certain jurisdictions, not just opportunistically, let's say on a one-off basis sale, but as a source of a permanent working capital financing tool that they could use on an ongoing basis alongside their other permanent sources of liquidity.
And how do you find their knowledge of these kind of structures? Do they approach you typically and say, look, we want to improve our working capital situation, our cash flow situation? What do you recommend we do? This is the size of our business. These are the sort of size of our receivables portfolios. Is that how it's approached, or do they tend to know that these kind of structures are available?
Absolutely. I think the knowledge in the market is actually there. A lot of, let's say, clients that we deal with at the moment, they do have a knowledge of the type or the design of the products that they require from the bank. So they usually come to the banking market with already a list of requirements that they might need for a transaction to function in the best way that is required for them. In some cases, this is based on prior knowledge, for example, of running similar programs in the past. Again, like especially in Europe and in the US, I would say that receivables financing markets generally are very established. These are very mature markets where a lot of corporates already use working capital financing facilities, in particular receivables financing, as a very a critical tool to meet their overall liquidity targets in the year, for example, or a form of alternative financing. So yeah, I would say that the market is sophisticated, the requirements are relatively bespoke, and obviously that's where the banking market needs to come in and be able to meet those specific requirements. And those facilities cannot be just, let's say, straightforward copy paste of of a deal on a deal by deal basis with what we've done in the past. Like they all have to be bespoke and centered to what that specific client's needs are.
Mm. And presumably the clients are familiar with the regulatory requirements and considerations, as well as the banks, of course. I mean, what are those considerations in terms of IFRS and US GAAP regulations?
Yeah, absolutely. Yeah, absolutely. I mean, great question. So in terms of, let's say, obviously, the regulatory requirements from an accounting perspective that relate to IFRS or US GAAP, I mean, those are driven by clients' jurisdictions, where those, let's say, selling entities are located or where the parent entities are located. As I kind of mentioned in the past, that there is this need to simplify working capital financing facilities globally in the market. So what we do face, let's say, as an interesting challenge when we set up these transactions is that we not only need to meet, let's say, our balance sheet requirements to structure these facilities, not only under IFRS, but and many times it has to meet certain and multiple accounting regimes. So, for example, IFRS and US GAAP both at the same time. So there has to be a lot of thought put into the right way to structuring these deals to ensure that they meet and comply with the accounting objectives of our customers in these various jurisdictions. But I would say that when corporates do reach out to us, they are already aware that accounting regimes differ. They are aware that IFRS works differently than US GAAP, that certain structures do work or do not work, and they would require alternative structuring, for example, where a US portfolio and a European portfolio would be involved. You might as well end up having a structure that works slightly differently for the US versus Europe to ensure that those accounting regimes are satisfied.
And typically, you say the clients are quite aware, typically, of how these structures operate and how they're put together, and the regulatory requirements. So typically, in a multi-jurisdiction type arrangement, let's say, how long would it take to put a deal together from start to finish?
I think it really varies, and it really depends on a case-by-case basis. I would say that a typical execution timeframe, let's say from start to finish, would be, I would say, a couple of months. Sometimes, obviously, due to complexity of these transactions, they might require more time. Obviously, where clients do have immediate financing needs, they're motivated to set up these transactions in as short execution timeframe as possible. Obviously, we would be completely aligned with those timeframes, and we could do these transactions in a matter of weeks rather than months. So anything is possible. We can reallocate our resources as and when is required to meet the financing needs of our clients. So I would say typically a couple of months, as short as a couple of weeks, could be longer than half a year, for example, as well. It is really case by case.
Yeah, but not too long, but generally. And how do you see the future development for this sector? Do you see growth continuing? Let's say the range of deal sizes continuing to expand. What's your view on the future for this sector?
I mean, I'm actually very positive about the sector in the future. I would say that in Europe, in particular EMEA, more broadly, we do see a lot of activity more recently over the years. So it's a space that is seeing, let's say, more demand, more needs, as I mentioned, for these, let's say, global transactions, as well as for what we have called the residual portfolios as well. So the market remains active. It's not really, let's say, becoming, what's the best way of saying this? It's not becoming, let's say, more muted, or the activity is not falling away into other regions or into other sectors, and in that sense. So I would say that my expectation is that the market will remain active. hopefully at the same levels as they are right now. Obviously, certain key elements that might impact that is regulation, obviously in terms of capital requirements for banks, that remains evolving, as we all know. So depending on where regulatory requirements for European, US banks, where they land, that might impact the receivables financing industry naturally as well, because that will put a requirement for banks to potentially change their capital considerations, and that might impact pricing, other structural features of these transactions as well. So obviously regulation remains an important driver of the activity of the industry, but overall, I would say that the industry is on the right path. It remains resilient. Obviously, it has been a rather tough market overall, with the subdued growth, with higher inflation over the years. Now it's kind of, let's say, coming out and becoming more and more active.
So Martynas, we're looking forward to hearing more from you and your fellow panelists. And just to remind everybody, it's the Alternative Receivables Finance Summit, which will take place in London at the offices of Clifford Chance, and that's on the 27th and 28th of November. Martynas Juskelis, Vice President of Structured Working Capital at JP Morgan, thank you very much for your time today.
So much.